That's great. Let me just bring in, because I want to get him in, the Bloomberg Best and the chief economist at Action Economics, Mike Englund, who's been patiently standing by. Mike, you were actually a little bit more bearish than the consensus. Give me your take.
Well, in general, we are encouraged by today's report. We had expected a slightly more modest increase in the non-farm payroll number, but we saw the driver in the report being strength in the work week, and in fact, it came in at 34.3, and February was revised up. The result is the hours worked index was up 0.2. From an economist standpoint, it's the amount we produce each month that's most critical, because that's what drives the labor market. And most economists are going to be revising up income and production numbers off of this because of that strength in the hours work data, and that upward revision in the second month of the quarter is going to boost some of the quarterly average forecast for Q1.
Right, and Mike was pointing out, which I thought was a good point, the no change in earnings, which is, does that bode well for, for any acceleration then in jobs growth, because you've got the oil prices that is really sort of crimping consumer spending. How do you figure what's going on there?
Well, it is the case that wages tend to lag the cycle, and one of the mechanisms by which we do create jobs and drop the unemployment rate is that wage growth remains low relative to the price gains for goods sold. And that weakness in wage growth, therefore, is a driver for the labor market, but it certainly isn't going to make the public any more happy about the cycle, and it's going to restrain income. I wouldn't necessarily view it as a positive thing, but wages are clearly lagging in this cycle.
And you can see a lot of action going on at the CME after this jobs report. Mike, how likely are we to continue to see this jobless rate climb down? Is it going to be slow and steady, or could we see, in fact, a sharp drop at some point?
Well, this drop over the last 5 months has caught economists by surprise. And I think, generally speaking, we're going to have a lot of discouraged workers in the wings that are going to pour back into the labor force at some point, but economists aren't going to be able to estimate this. So maybe we drop toward the mid-8s at some point mid-year, and then we pause for a period while these people start to re-enter.
Betty, just a quick update on what's happening in the market as we pointed to positive reaction in stocks, and stocks like Ford, for example. You were talking to Mike about this idea of people working more. Automakers are a great example of factory workers getting more hours worked, and also you talked about oil. Oil is moving higher on this news. Whether that helps the consumer down the road is another story, but we've seen commodities react positive to this news, as well as the overseas markets, which we're already seeing some strength, for example, in Europe this morning ahead of this number because they thought it would be a strong one. Right.
Great point, John. I want to just get back to Mike real quickly, though, because or Mike Englund, because the biggest risk, Mike, that you see in the jobs in the jobs market. This is a good, solid report, but going forward, we've got oil, we've got the Fed. What are the biggest risks?
Well, we do think that it's unclear which way the Fed is going to take. Public concerns about policy. Some feel that the outlook suggests that the Fed has to continue to ease policy, perhaps adopt QE3. Others are actually spooked by the existence of QE2 and make the case that uncertainty is being increased by the Fed's adoption of QE2. If you look at Fed speak over the last week, it appears to me the Fed is making a concerted effort to address the critics and, in fact, is talking tougher on our tightening strategy. So we may be seeing the Fed tightening even before the end of the year, which would have caught economists by surprise before this week. So that may be the focus for the next 2 to 3 months, and that really is in the context of these surging energy prices that you cite. Effectively, headline inflation is going to go through the upper end of the 1 to 2% comfort zone to the 3% area by around June with current commodity price levels. And that's going to shock a lot of people, even though core inflation remains down near the 1% end. That's the low end of 1 to 2% zone.
In that regard, Betty, it's going to be important to watch Bill Dudley, the New York Fed president, who is speaking a short time from now. He's one of the core three, along with Bernanke and Janet Yellen, who want to keep QE2 going and who would be open to QE3. We'll see if he talks any tougher. The fact that wages aren't going up helps make their case that we're not going to see long-term inflation, that these commodity spikes can go up and then drop quickly. And unless you see wage pressure, you don't have real inflation. Going to be interesting to see how he, Yellen, and Bernanke frame this going forward. Bernanke speaking next week. Right, and that makes the case, as you say, for him that to keep quantitative easing going. Thank you so much, Mike Englund, for joining us. He's a Bloomberg Best economist on jobs, chief economist at Action Economics.